Hey guys, Akil Stokes here, and in today's video we're going to talk about what type of profits you should expect to pull from the financial markets. Hey guys, welcome back to another video. I believe it's week 6 in our 2021 trading video. I'm lost already, but thank you as always for deciding to take some time out of your day to watch this video. If you're brand new, my name is Akil Stokes. I'm a Forex trader. I'm a trading coach over at tier1trading.com. And this is a weekly video that I put out, not only showing you some of my best trading opportunities that are on my radar for the week to come, but giving you educational tips on a weekly basis that will help you become a consistently profitable trader. Now, if you follow me on social media, and I'm not talking about the fake me, so if anyone sends you a DM, not me, shoot them a question back that only Akil would know or only a trader would know, and you'll scare them away, trust me. But if you follow the real me, you know that I post a lot of inspirational and motivational stuff on my social media platforms, including trading quotes. And really, what I wanted to share with you today, or I guess the topic that we're going to talk about today, comes from a recent trading quote that I shared on, I think it was Thursday. So give me a second, I'm going to find it and I'll read it to you. So the quote actually comes from Dr. DeMartini, who is a mentor of Jason Grayson. I believe he interviewed him on episode, gosh, I forget it, one of the early episodes, maybe 23, something like that, of his Always Free podcast. But it says, every time you compare yourself to other people, you dilute the clarity of what your own mission is. And the caption that I wrote with this was, I said, if you think you're in competition with everyone else or anyone else, you've got it wrong. The only competition is between yourself and your past self. When you spend energy worrying about what others are doing, you take energy away from what you could be doing. Focus on your mission and your mission only. And that's very important, especially in trading, because in trading we have the habit of kind of listening to the outside noise and seeing the highlight reel, which is social media and what everyone else is doing, and sometimes that discourages us. One of my best friends, the one that actually got me into trading, he was a phenomenal trader, but never followed through with any of his systems for various psychological reasons. But another reason was that he was never good enough. Every time he would go online on the internet, he would see someone that was doing better, and it became like a race. I gotta do better to him. I have to have the best system. And because of that, he wasted many years with what could have been a very profitable trading strategy, just ditching and dumping them and trying to find that next best thing. So it's important that we do not compare ourselves to these people for that reason. Another reason is, half these people are lying. Half the people that you're going to see on social media are either internet scammers, where they're selling you these inflated returns to try and get you to buy a course or a system or a service or something of that sort. The other ones, maybe they're actually that good, but they just hit a hot streak. They hit that hot streak with an inflated position size, and well, there's a reason you never hear from them about a month later. Why? Because that account, boom, blew up. So the only person that you really should listen to when it comes to deciding what your expectations should be are you and your system. And we're going to talk a little bit about how to go about determining what's a proper expectation as far as financial market profitability. So let's get started and work through this process. I'm going to break it down into, I'm going to try and break it down at least into a simple 3-step process, because you guys know me. I'm all about understanding how the human brain operates and what's the best way to learn and retain information. And guess what? The human brain likes things that work in sets of 3. It's the simplest way we can do things. So let's give it a try. So to break this down into 3s, the first step that we want to do is we want to choose our minimum. The second step that we want to do is choose our approach. The third step that we want to do is choose our plan of attack. And we'll start with the first one. So choosing your minimum. Your minimum is basically how much do you need to make in order for this to be worth it. So basically comparing, thinking about your opportunity costs. One of the greatest stories I remember is actually with my business partner in my real estate business. And I had moved into a new house after finally becoming successful at trading. And this new house had a big lawn, a massive lawn. That's something I never had before. And I remember when I told him that I was paying someone to mow the lawn for me. And he said, "What? We don't do that. Like we're both kind of blue collar people, right? We don't pay people to mow the lawn. We do it ourselves." And I was explaining to him at the time, well, it was like we had a really big lawn, right? I didn't have the drive around equipment. It was going to take me a good amount of time, maybe 3-4 hours to do the entire lawn. And that meant taking 3 or 4 hours out of my weekend. That's time with my kids. That's also time that I do to develop videos. So it was the first time I really started thinking about opportunity costs. Is it worth it? It is more than worth paying someone to do this task for me so that I can free up time to do other things that are going to make me more productive in the future, right? And you think about it, that's the whole goal of kind of being an entrepreneur or growing your business in general, right? We want to automate and delegate for the reasons of not just because we're lazy, but to create time that we can use in a more purposeful manner. So what is our minimum, right? We're going to invest a lot of time into trading, a lot of time. I'm not talking about actual trading. I'm talking about learning how to trade. I'm talking about back testing. I'm talking about the entire process that it takes to become a consistently profitable trader. And if you're familiar with this channel and my message, maybe through my podcast, you know that when I get asked a question, how long is it going to take me to become a consistently profitable trader? I usually say probably between 2 years, between like 9 and 18 months, something around then. And that's 2 years of dedication. So is your benefit, meaning what you're going to achieve from trading, worth it, right? No different than going to a job interview, right? When you go to a job interview, you're thinking about, hey, I want a minimum salary. If I don't get this minimum amount of salary, I'm not interested in the job. And this needs to be the same way. This is also why I say the boomer busters in that Mark Douglas kind of 3 trader pyramid, the successful, the boomer busters, and the failures, quitters, whatever you want to call them. I think the boomer buster is the most, I think that's the worst category to be in, right? Obviously, if you're successful, that's good. If you are failing, that's bad. You failed, but in most cases, those are the people that think trading is a get-rich-quick scheme. They come in, they blow money really, really quickly, and then they go on to the next scheme. So at least they don't waste a lot of time in trading. They waste money, I suppose, but they don't waste a lot of time. They can go on to something else. The people in the middle, the boomer busters, those are the ones that really try. Most of them have the right idea about what trading is and what can be achieved. They just can't do it. They're breaking even or making a minimum amount. But what they're wasting on the back end is time. So when I think of minimums, I was always taught this by my original kind of investing mentor, I guess business mentor as well. He said, Akil, you want to outperform the S&P, right? The S&P 500. Now, historically, the S&P 500 averages between about I think an 8 and 11% return per year. So what I need to produce in the market needs to be above that 11% mark. Why? Because if it's not above that 11% mark, I'm wasting a lot of time doing all of this stuff to create a return when I can just invest in the S&P and do nothing and have it make it for me, right? Why would I want to waste more time to get the same return, right? Thinking about time as being kind of the biggest asset we have. So that's the minimum requirement. I need to outperform this fund. If I don't, it's not worth it. Now, I also understand that the biggest return in the S&P, I think, was 2013, and you guys can correct me if I'm wrong. I think it was like 30-something percent, 32%. It would be good if I can consistently be at that level or above that level. That way, I can always say that, hey, if the S&P has its best year, at least historically year to date, I don't have to feel bad about saying, hey, I could have had everything in there and captured that year. I'm going to steadily basically be the best version of the S&P year in and year out. So that's kind of my upper goal, is to be around that level. My minimum goal is to be above that 11% level. Now, you can choose whatever you want. You can choose a multiplier of it. I want to, outperform it by, a certain percent or something like that. The key is you want to have something to compare it to think about your minimum. That way, you know that you're actually making the right time investment when it comes to investing all of that time and energy into trading. Now, there are other aspects as well, right? We want to get into trading to control our own finances and stuff like that. That's a big part as well. But at the end of the day, right, we also want to make money from it. So step one, choose your minimum. Step one, choose your minimum. That's how I went about choosing mine. Step two is choose your approach. This is where we get more kind of into the trading strategy, the actually trading stuff. What type of trader are you going to be? Are you going to be fundamental? Or are you going to be technical? Are you going to be counter trend, trend continuation, price action, systems, right? There's no magic answer to this, but this is where you want to start discovering, hey, what is my trading system? How am I going to approach the market? And this encompasses the whole strategy development or strategy picking, the whole backtesting session or section of your trading journey, where once you've chosen how you want to trade, you've acquired a massive amount of data from that system, so you can see historical results of what this system performs. Now, you're not worried about profit and loss at this time. You're just worrying about pips or ticks, right? That's going to be the unit of measurement that will allow us to see what our profit and loss are, right? You want to have that data, because once you have that data, those numbers are going to allow you to figure out every single other question that you have about the market. So step 2, choose your approach, and of course, do all of the work that goes with choosing your approach as far as strategy development, testing, fine-tuning, all of that stuff. Step 3, plan your attack, right? So now that you have all of these numbers, all of this data, this is the fun part, right? Backtesting sucks, right? It's fun for a period of time, but for most of us will say it sucks. But the gem of backtesting is you have more data than you can deal with. And once you have that data, the possibilities of how you want to manipulate it and filter it and do this are endless. It's amazing. It's like a kid being in a candy store, especially when you get to like the position sizing and stuff like that. But now that you have all this data, now that you've done all this work, now you want to fine tune it, right? Now you want to plan your attack. How am I going to trade? Am I going to stick to a single strategy? Am I going to do multiple strategies? Am I going to do a single pair or a single asset class? Am I going to do multiple ones? This is where you can really take those numbers and figure out how is the best way to maximize what I'm doing. And again, there's endless ways. There's no wrong or right answer. Everyone's different as a trader. But once you have those numbers, you can play around with, you know, exactly what type of approach you want to do. And of course, compare them to the alternatives as well. So those are the 3 steps, right? Now, if we broke those down into kind of, 3 broader ideas, right? 1 is going to be goal setting. 2 is going to be testing. 3 is going to be fine tuning. And the fine tuning is the most important part, because that's where you're finally going to get the answer. So you have this minimum. Now you can play around with different money management strategies, whether it's fixed percentage, whether it's fixed position size. With that fixed percentage, am I going to risk 1%, 2%, 0.5%? You can see the differences. If you're using fixed position size, am I going to use a smooth smooth ratio money management approach? If so, am I going to have a conservative delta? Am I going to have an aggressive delta, right? You'll know the numbers where it's like, hey, I need to stay above this maximum drawdown, or I'm allowed to take this maximum drawdown. And well, let's do this. Let's pop into a chart real quick, and I can show you kind of the examples of how you can play with stuff. All right, so here's a quick look at what was my best year of trading. It was, again, 62% return, 75% with some money management there. I forgot what year it was. It had to be 2000, maybe 15, because 2016 was pretty disappointing. I think 2017 is one where I started off with like a 16% drawdown, right? It was all downhill from here. But this year was very, very, very good. Now, I want to show you an example of just a very, very quick one of how you can manipulate the data. When I say manipulate, I don't mean in a negative way. Although, I would say this. I mentioned earlier about scammers and people out there that sell you a certain dream where it's like, hey, 500% return a year. This is a little bit of what they do, right? Just they use it in a negative way, right? So if you look on the left-hand column, that's the actual return with no money management. And the right-hand column is with an added money management system, right? The delta is the multiplier. This is basically that tells us how aggressive or conservative we want to be with adding to our position size, right? Right now it's a $5,000 delta. This was based off a $10,000 account from our live trading room. So it was about a half delta, which is pretty conservative. Now, let's take it all the way to the extreme, right? If I made this delta super aggressive, I want you to look at what's going to happen to this number right here, right? This 75% return. Watch this. Now, I would never do this. I don't advise anyone do this. This is absolutely stupid. But just to give you guys an idea. 1, 2, 3, boom. 62% automatically just went to a 6,386%. Now, again, I don't think any scammer out there would be dumb enough to think you would believe this number, but it's a good example of how they can lie without lying, where it's like, hey guys, I made a 6,000% return, and I guess internally they justify it by saying, well, I could have, because the money management, if I would have done this, it would have been blah, 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 right? Now, some of you guys are maybe new to the channel. You're like, oh my gosh, this is real. How can you do this, right? Why would you say you would never do this? It's 62% to 6,300? Of course. Well, the thing is the risk. And remember, great traders, or good traders, there we go. Good traders are great risk managers. I guess great traders would be super great risk managers. But good traders are great risk managers. And what I mean by that is the number one rule of trading for all of us is don't go broke. Number two rule of trading is don't go broke. We can go down the line 3, 4, 5. Guess what? They're all don't go broke, right? So holding on to your money is the most important thing. And although maybe the outcome of the bigger picture, the 6,000% return is appealing to you, if you look at the journey, right, there is a point in time where on a single trade, there was a 35% drawdown, right? Because you're so aggressive with your, or 37% drawdown because you're so aggressive with your money management. I don't know if anyone in their right mind would be comfortable taking a 37% hit on a single trade. Or a single, I guess it's a single week of trading, excuse me. Regardless, it's bad. So you would never want to do that. But you can see how you can become more aggressive or more conservative with these numbers and how it's going to affect your outcome. Now, let's do this one. This is a more realistic one, right? 62 to 191. You're still going to have a pretty significant week of drawdowns, a negative 12%, but it's an outlier, right? And again, if you go back to being conservative, which I am, I'm very conservative, don't tease me. At this point in my career, I'm more concerned about holding on to money versus making more money. And some of you would say, well, Keel, this is the live room account. Why wouldn't you be aggressive with it? Because it's kind of fun money. My answer to that is this, right? You never want to form bad habits. I would never, I don't care if it's a demo account, right? I would never want to take actions in a demo account in a different way than I would in my actual account. Why? Because if I form those bad habits there, they're more likely to leak over to my real account. And then just, I'm so afraid of going backwards. I'm so afraid of failure that I never want to put myself in a position where I can, I have a chance to lose everything that I worked so hard to gain. But you can see this is the moderate delta. This is what I personally use, about a half delta. And you can see that 12% drawdown week ended up being a 6% drawdown week, which wasn't bad. You can look at all the rest of the, this is actually gonna be trade by trade, not week, I apologize. Which makes those other numbers even worse. You can look at the rest of my trades where my risk is at 1, 1, 1, 1, 1, 1, 1. There should be some 2s in there, 2s, 1, 3 right there. Boom, 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 right? All of them are pretty low aside from that one 6% drawdown, which was an outlier trade. But you can see how once you have the numbers, you can actually put all your numbers into these spreadsheets. You can play around with them, and you can find that mix between being as profitable as you can while maintaining your risk requirements. Now, while we're on the topic, just real quick, speaking of kind of spreadsheets, if you guys haven't done so already, make sure you sign up for next week's Emergence 2021 workshop. It's going to be a 4-day, 100% free workshop. I checked on Wednesday, I think we had 700 people signed up already. Make sure you do so now, right? Seats are going to be limited for the live sessions. We will record each and every session and we'll mail them to you, but you still need to be registered. That way we have your email. That way we know who to send those recordings to. But if you plan on being there live, make sure you log in quickly, because there are a limited amount of seats that we can have for the live stream. But one of the cool things that we're going to do during that live stream is we're actually going to bring in one of our traders over at Tier 1 who's been with us for a while, and he's going to actually show you kind of what the business side of trading looks like, meaning all of the data that he's acquired, why he's chosen that data to acquire, what he's doing with it. And I think it's a great example of what we're talking about here in today's video, where it's like, hey, once you've done all the work in acquiring that data, now you can have fun manipulating it and getting it to kind of molding it to fit what you want your trading future to be. So that's pretty cool. So make sure you sign up for that, and let's head over to the charts. All right, so let's head into the charts. And I guess before we do, let me give you an update on how my week of trading has been. And I can sum it up pretty much in one word: boring. Which isn't a bad thing. Again, it was an active start to the year. I did take 2 trades this week. I started off with 1 loser. I did have 1 winner to end today. I finally got filled on a pound dollar long, which did achieve first targets, but it's still an active trade because second targets are still present. This is the one we talked about last week where we're looking for a bigger move to $1.40. So we're going to see if we can get a potential home run trade out of it. If you guys have been following along each and every week with this video, I attempted a home run trade, and by home run trade, basically a larger second target position trade a little bit earlier in the year and failed. Nothing has changed with the overall analysis, so I'm still shooting for that 140 level. Nothing has changed, and we're going to see if the second time is a charm. But let's head over to, let's go over to Euro Yen. And I'm actually going to jump to the weekly and give you a bird's eye perspective of what's happening here. The Euro Yen is trading at a previous level of significant structure, right? You can see we hit this level early January this year. And if we look left, structure leaves clues. This was that same level of resistance that was created back in February 2 years ago, 2019. So when I look at levels of resistance or levels of support, just levels of structure in general, I look at them as what's called decision points, meaning the way that I do my analysis is very heavily based on structure and how price reacts to that structure. If price does one thing, then I predict this. If price does another thing, then I predict that. So I'm always looking at key levels of structure in order to make my prediction on where price or what price is likely to do next. And then structure comes into play again, ultimately where I think price is going to go next. And while we're on that topic, where I think price is going to go next if we break this level is going to be the upper end of this small little consolidative level right here at about 129.10s, around that area. Now, you may be asking yourself, Akil, well, what gives you the prediction, the projection that price is going to violate that level? And first and foremost, I don't know, right? And this is the reason why I say we have to be predictive in our analysis, reactive in our execution, meaning we need to run through scenarios in our head. If price does this, then I do that. But we're not taking trades based off that prediction per se, meaning I'm not taking a bullish trade right here because I'm saying if price action breaks the structure, we'll go higher. No, I need to literally see that price action has violated that structure. Then I need to be very quick to react to get me involved in that trade in that direction. And running through these scenarios in your head over and over again before they happen allow you to be quicker with your trading reflexes, I guess you can say. But fortunately, I've also been involved in the market for a very long time now. And one of the best learners that you'll ever get, aside from Jason Grayson and myself, wink, right, is experience. How cheesy was that, right? Is experience, right? Experience in the market where you see things over and over again. And some of you guys may hear this referred to as trader intuition. And intuition is a real thing. As a newer trader, I think gut feeling is disguised as intuition, where traders have a sense of something, but it's not really an intuition. It's really a gut, a hope, a wish, an emotion. But as an experienced trader, intuition actually is a real thing, and it's gained from the experiences that you get in the market. Again, it's no different than think of a veteran athlete who maybe lost a step there a little bit slower, but they understand the game better. Maybe Tom Brady, who just won a Super Bowl, is a perfect example of that. So what I'm seeing here is a very sloppy, inverted head and shoulders pattern. And essentially what that means is this. Price action rallied up from a previous structure low. We consolidated here, which is going to end up being our very sloppy left shoulder, right? We then violated that shoulder level, that consolidation to the downside, and now we came back up, returned to these highs, and are consolidating again. Now, what makes this a little bit different than, or I guess where the intuition kicks in as far as just seeing this as a rotation and the start of a bearish trend is the fact that we were able to push all the way back to the highs, right? Good trends happen quickly, right? Good moves don't last. I learned that lesson plenty of times in my real estate ventures, right? So strong trend, same thing. In a strong trend, you don't typically get deep pullbacks. You get consolidation or you get short pullbacks because there's a very heavy presence on that side of the market. When you get deep pullbacks, right, ask yourself this question. If the bears really wanted to protect this level, if the bears had really taken control, would they allow the market to push all the way back up to where they initially got involved, right? They started pushing the market down at 127.35. If you're a seller, would you allow the market to return to that level, and not just return to that level, but start hanging out around that level? And the answer is no, right? Not if there's a great amount of selling conviction in the market. So whenever I see something like this, I get the opposite signal. I say, hey, wait a minute, there's not as much selling pressure as I thought in the market. This could be the opportunity for the bulls to retake the trend, as we've seen since November 2020, and we may see a breakout. And if we get that breakout, again, and this is basically the psychology of an inverted head and shoulders anyway, but if we get that breakout, we're doing one of two things. One, it's going to show us a whole lot of buying your interest in the market. Two, it's going to skunk out those sellers, because guess what? If you are a seller in the market, if you sold anywhere around here, where are your stops at? Your stops are hidden right up there. So not only are new buyers interested, but old sellers now have to become buyers as they escape their previous short position, which is clearly not working in their favor. And then you see that pop. And if we see that pop, we're likely to go to that previous level of structure. Now, what else do I have lining up at that structure? I'm going to go back out to the weekly and do some technicals for you. We're going to start off by drawing a Fibonacci extension. If you're not familiar with Fibonacci's, we're actually going to go over this in the Emergence 2021 workshop. I say that because I don't remember the last time I've talked about fibs at a workshop. Usually, I don't want to say dumb it down, but we usually don't end up covering that. But we're going to revisit this time just because we haven't done it in a while. It is going to go hand in hand with advanced pattern formation that we're going to teach you. But if I look at the most recent swing low to swing high in the market, it's going to be right down here. And I can take a Fibonacci and I can say swing low to swing high and back down. And that's going to give me a 127 right here at that 129.10 level. Remember, that's the same level that we had that structure level drawn at before I mistakenly deleted everything. I can also take a Fibonacci extension. Let's actually see what this one gives us. I didn't do this one in the past, but this previous move, look at that, same thing. So we have two 127 extensions from the previous swing low to swing high right here, and the most recent swing low to swing high. Now, one more thing that comes to mind while we're looking at here is we often team, not often, we always team, at least we attempt to team, they don't always work out, Fibonacci extensions with equal measured moves. So if we just take a look at this, nope, that's not going to be, oh, actually, I didn't even think about that. How about that? This would end up being an equal measure move. This isn't all too relevant at the time, but it is interesting that we would complete at this level. But if we copy and paste this previous move right here to here, right, and have that basically be our A, our B, our C, and our D, we're going to have an AB equals CD pattern right at that level as well. So this is no different from you, for you guys on the platform to understand the CTS. This is no different than CTS, right? This is AB equals CD. This is Fibonacci confluence. This is structure looking left. You are building a case for entry, and I do think this would be an excellent opportunity for a short trader to get involved in a counter trend move. And to go hand in hand with that, if I think this isn't a good opportunity for a short trader to get involved with a counter trend move, what do you think it probably is for someone who is looking to get long at the breakout? Think like the other trader, right? Probably a great opportunity for you to take profits and say, enough is enough. I don't want to be greedy. Let's take my money and let's look for the next opportunity. So a good opportunity here on Euro Yen. All right, I'll see you guys Monday for the workshop. Bring your notepad, bring your pencil, bring your thinker. And until next time, plan to trade, trade your plan. Take care.